What is up, YouTube, and welcome back to another Fridge Financials video. And in today's video, we are looking at some higher end leap option plays that we could potentially be looking at doing between now and the next year or so out. So if you're excited for today's video, feel free to like the video, subscribe to the channel, and as always, turn on those bell notifications for all future uploads. And this is kind of leading off of the ideas. We had the $500, leap option plays. We have the $1,000-ish leap option plays. Now we're getting to the higher roller side of things. And it's not just your standard NVIDIA, Apple, Google. It's not those kind of ones. We're looking at companies that have had a little bit of a pullback recently, more or less, or companies that I think I like overall, and I think they're going to do relatively well between now and the next year or so as we continue to move forward. So again, if you're excited for the video, make sure you subscribe. Let's get that number of people who are not subscribed but watching under 80%. It's one click of the button, really easy to do. Feel free to do it down below. It's free of charge, and you get Fridge Financials at your service for videos and for financial content. Now, without further ado, we're going to be looking at going into the first of 5 companies here, and the first one we're looking at is DraftKings. Now, as you can see, DraftKings here is laid out as having a nice little bit of a recovery since it was down in like the $28 to $29 range or so, as you'll see from a little while ago. And again, this is like last year's chart, and now we're kind of trading a little bit sideways again. Now, for me personally, I'm someone who just likes DraftKings, not just because of the chart perspective, but more because of just who they are as a company, right? DraftKings, as we know, is a sports betting and gambling company, all digital. It's not like one of those like Caesar's Palace, like in-person casinos. So it's an online platform where you can do sports betting, gambling, all that kind of stuff there. And they're popping up all of the plays from advertising through YouTube videos, maybe through, sports arenas and stadiums. There's a lot of advertising behind DraftKings, and I think it's going to pay off long term. A lot of people love to gamble and bet on sports. We know football is coming up around the corner here. Preseason has already started. And with DraftKings, they're almost a profitable company. They're very, very close. Right now, they're at a negative PE ratio right now they're at negative earnings per share, I should say, of negative 0.65. So they're still a negative profitable company. There's no profit right here, right now. They're still losing money, but it's getting very, very close to being a profitable company. And it's kind of just like what reminds me of SoFi. SoFi, when they went from a negative to a positive earnings per share, the market loved that. It was almost like a euphoria moment. And now SoFi was trading at $8. Now it's up at like $23-ish as a result. So, in taking a look at DraftKings here, as you can see, the fib levels that I have mapped out here are from the all-time highs now to the swing lows right after that. And again, it consolidates a lot in this little, golden zone here as a result. It broke out, and now it is retesting into the red zone. This is that 61.8 retracement here, and I'm hoping that it's able to kind of go back up into this 49.7 range. Again, it's retested it, and it has been rejected from it multiple times here. The hope now is that we break through, and we're on our way up to $60 per share potentially, which would be absolutely amazing. So right now, it's kind of consolidating on that support line of 42.08. And again, you'd run up to about $50 a share. Then if it breaks to that one, your next goal would be up to about $60 per share. And taking a look at the leap options, which again are calls that are super dated and far out in this case. If you wanted to go to, say, June of next year, potentially, you could be looking at some of these deeper in the money options that might cost you anywhere from like $1,500 to like $2,000 potentially, however you want to really look at it. Again, if you wanted to go like super, super in the money, you can do a $25 strike price for $2,000 about, give or take. Some people are already doing that, as you can see with the open interest here. That would put your break even at about $45 per share, which is very, very doable because it's already at 44. And again, you're giving it almost a year to have this happen. As more earnings come out, if DraftKings can become profitable, you're going to see hopefully this next leg up from 49.7 all the way up to $60 potentially. Some very good returns. And again, it gives you access to 100 shares of DraftKings without paying the full price for it. Instead of paying $4,400 for it, you'd only pay about $2,000 on that kind of option that you have right here, which is pretty good. Again, if you want to go a little bit lower, you definitely could go to like the 1,500 or so. If you're very, very bullish on them very long term, you can go to a way far out December of next year one. And again, those ones can become a little more expensive, as we know. There's a lot of open interest at the 35 strike, which puts you at a break even of about $48, $49, maybe close to $50 a share, which isn't too bad. We have another open interest right over here on like 51 for a break even. But DraftKings to me is a company that everybody knows, everybody sports bets on it. I see ads all the time from DraftKings. And again, people love to gamble. Gambling is always there. Casinos have always been around. It's very unlikely to see a casino go, broke and to go bankrupt and file for bankruptcy. It does happen, but very unlikely. And I think with them legalizing more and more sports betting in other states across the U.S., you could definitely see some good numbers for DraftKings. The next one we have is UPS. Now, UPS has had quite a tumble as of recently, as you will see. It has just came down and down and down and down and down. Okay, from the all-time highs or from the pretty much to the very close highs of $201. Again, it started coming down with earnings not doing as well. And it makes sense because think about it, when COVID was around and it was, everybody was staying inside, everyone was buying things online, getting things shipped. You couldn't go in the stores. So UPS, FedEx did extremely well. And then as things opened up again, they kind of started to be stagnant. Again, trading kind of a little bit sideways, coming down slowly but surely. For a little bit of while, it was trading in that golden zone here, and now we are at this very, very bottom. I don't know how much lower UPS could really go, but the reason I do like this kind of option here for a leap here is because the dividend payout. Your dividend yield is 7%. As the stock price comes down, the dividend yield goes up. That's how it always is going to go. So since UPS has come down so much, you have a 7% dividend yield, and people know UPS. It's those brown trucks you see driving around, dropping off packages everywhere. Yes, they do have competition with, Amazon, with FedEx drivers and all those kind of things like that, but a 7.38% dividend yield isn't too bad. I believe the CEO or someone in the CFO, someone like up in that kind of board, recently rebought some shares and repurchased more shares as a result of it, which again, if it was a dying company, they wouldn't probably be doing that, but they did. So which is really, really good to see from a company overall. And again, the hope would be to get back into this golden range here of where it was trading sideways on the daily chart here, breaking out, going back down, breaking out, going back down a little bit, which would be about $130, which is a long ways away here. But, the first level of support I would have is around the $100, $105 range, potentially looking at here, which again, you're looking at a decent $13 upside potential. And again, taking a look at the options chain from way far out, you want to go into June of next year, feel free to. You could buy a $70 strike price, puts you at a $2,000 cost basis, about a $90 break even, which is literally about like $2. And then anything after that is profitable. People say, Fridge, well, why would you go so deep in the money instead of out of the money in this case? And again, the reason why is because it makes your break even be a lot lower. Right? Even though we have a whole year basically for this contract to expire, if it moves up $5 in the next 3 months, you already are in the money and profitable on UPS. It does cost you more, which is $2,000, which does obviously cost you more, but it gives you access to 100 shares worth. Instead of buying 100 shares for $8,000, you get access to them for $2,000 for the whole year. And again, all you need to do is move up a couple bucks. Hey, move up $3, $4. Great. If it starts pushing to the $100 mark again, that'd be amazing. That would make you in some really good profit there as well. So UPS to me is a good option. And again, also you have potential dividends. If you want to exercise your contract, you could exercise it at a cheaper price. So say it goes up to say $129 and you bought a leap call option, you could just exercise the $89 strike price, whatever it is you pick, and you get the dividends as well. So a very nice company to take a look at for me. Again, I don't think UPS will be a company that just goes bankrupt relatively quick. It's got a very large market cap of $75 billion with a B. Could be a good potential play after all of this downside pressure here. The only thing, again, that is cautious about, which is why I always say do your own research, even though you're having share buybacks from CEOs, CFOs, whoever it is. They also, I think, did do an optional layoff package for people, trying to cut back on the workforce. But again, the labor market overall in the U.S. is just not doing well right now. So a lot of companies are starting to cut back on the workforce. Intel cut their workforce. UPS is doing it. I think Microsoft hirings were flat year over year from their last earnings report. So the labor force is slowing down overall. But again, looking into the companies, seeing what they're doing, definitely will make a difference. So that's my company of United Parcels, UPS. The next one we have is Chipotle. Now, Chipotle has come down very much so since their earnings. They had a huge miss on their earnings report, and it's looking like it's starting to find that bottom here, which to me is good. Again, when you find that nice little bottom, hopefully the goal would be to look to see what the next level of resistance is to come up. Again, it came down, and this level of resistance has been touched multiple times. 1, 2, 3, there's like all these touch points over here. So 47.81 in that range isn't too bad of a window to look at for this stock to retrace back to. Okay. Chipotle, again, isn't going anywhere anytime soon, in my opinion. Market cap is very, very large at almost $57 billion. But again, there's stores all over the place. People love going to Chipotle. There's other stores that are obviously competing with Chipotle, but there's so many locations nationwide for Chipotle. Everybody knows who they are as a company. And taking a look at the options chain here, we can go deep in the money back to like June of next year potentially. These ones actually aren't that expensive, relatively speaking, which is good. Again, you're looking at, if you want to go really, really far in the money, like a 34, for example, that puts your break even at about a $45-ish break even. If you wanted to go super far out in this case, that's where it gets more expensive, but it'll put you in a really good chance of being profitable over, again, almost 2 years. The problem with these leap options is that, again, you have to be okay with holding shares for a very long term. If you don't want to holding your cash up for a long term, you don't have to close it on the last day. You can close it early, but it's something to keep in mind about as you're going through these options. But as you will see, a lot of people are already having interest in these kind of option plays here for Chipotle for about 2 years out here. Again, that recent pullback kind of sucks, but when you have those recent pullbacks, that means you get a nice buying opportunity potentially. You can buy options or shares cheaper if you really want to. So again, Chipotle on my list as a potential one that could be a nice profitable company long term. The next one we have is Hims. Now, Hims has been a little bit of a roller coaster ride, as you can see. Look at the daily chart here. Again, as high as $73. Earnings came in with a big miss, and now the stock has kind of retracted back into that golden zone, as you'll see here. Very, very interesting company. Again, they broke their contract with Novo Nordisk with the weight loss drugs and everything else like that. I still see a lot of ads now popping up in Hims online, which is good. So they're putting a lot of money into their advertising. And people have been loving what they've gotten for, medical and pharmaceutical things from Hims as a result of it. As you can see here, this was a nice level of resistance here at 62.49. Now it is retracing back into this golden zone. My thought would be maybe to look and see if it comes back closer to that $42-ish range down here. Because again, we had a little bit of support here. We had that support here earlier before, back in, I believe it's around like the February, March area. And then we can hopefully hope for a nice run back up to the upside. Again, long-term, looking at Hims as a company, this one is a smaller market cap. It's only $10 billion. And believe it or not, it's trading relatively at a similar share price as Novo Nordisk, which is about $56 billion. So, you can play either one of those pharmaceutical companies long-term. Either way, it works. Again, but if you wanted to go out to, say, June of next year, you're paying a little bit more of a hefty price for Hims. Again, if you wanted to go deep in the money, looking at about $2,000-ish or so for this kind of option play here, potentially. But again, $2,100 puts you at a break even of 51. It's at 46. And Hims does have a lot of volatility, so you could get those big swings in either direction as we go. But these ones will cost you obviously a little bit more, as you will notice here. And if you wanted to go even farther out to say the end of next year, again, you're looking at about $2,000-ish per leap option call that you're looking at here. So another potential good play. Again, these leap options are designed for you to take advantage of a stock moving up long-term, not short-term. Again, their earnings was a bit of a disappointment, so I wouldn't say looking at this one yet, I'm optimistic. I think it still has maybe some more to the downside, but if we get a nice little, support bounce here at 42, you can go back to 48, back up into 54s, and maybe even test the resistance at 62.5. So some really good, levels to take a look at and keep in mind about for Hims. That's me personally. Again, do your own research, do your own kind of, charting and stuff like that, so that way you don't just follow blindly Fridge Financials. And the last one we have is Trade Desk. Now, Trade Desk at one point was trading at $142 per share at the end of last year. Then It sold off a little bit. Then earnings was a huge disappointment where it just fell. We got a rebound back up to $80.61, where the other earnings took it down again. Then it rallies back up to the golden zone, and the earnings take it down one more time. They had bad earnings. They cut guidance. I think they're looking for a new CEO or CFO also on the board, which is obviously a concern for people. And it's a interesting company to kind of see how it's just reacting to earnings here, right? Last 3 earnings apparently have just made it have these red days across the board. So very, very tough play here. But the hope would be to find some support and see that recovery. Again, with what I'm looking at right now, it's not having that. It's down 7% again today. So you got to look to see this kind of nice little, reversal here before you start looking at going into deep in the money call leap options potentially here. But this company was recently added to the S&P 500. They don't just put companies in for no reason. They do it with purpose and with certain rules and a checklist that you have to hit in order to be included in the S&P 500. And being included is a huge deal because a lot of retirement accounts buy into like SPY ETFs, VOOs. So it gives you that exposure to this company just through those kind of broad index funds, right? So hopefully Trade Desk has some sort of pivoting moment. It doesn't have it yet. Again, we're looking for something like very similar to this one where it came down, it had a pivoting moment. And then once you get that pivoting moment, then you can start going up into the upside here. But again, if it gets a pivoting moment, you're looking at first level of resistance will be at $66, which is about $16 upside, which is pretty good. Then 80, then into 92, into that golden zone. Taking a look at the options chain, same thing, going out into June of next year, about a year out or so. Again, you're looking at some pretty expensive contracts, like $1,500-ish to $2,000 or so, which is obviously, what you want to pay for. So that way your break even is super, super small, right? Again, you paid $2,000 for this one here. It puts it at $55. It's down. It was basically close to 55, before market open today. So a lot of implied volatility swings probably going to be happening with this kind of stock here, but it is potential to have some good returns. And again, if it goes to $60, $70, $80 on a recovery, that will be a good play for you to take a look at long term. If you want to go way, way far out, September of next year, those get even more expensive. But, a lot of people have open interest in this kind of company here. So Trade Desk, me personally, wouldn't look at buying a leap option yet, but it's a ticker that I would keep on my radar to take a look at to see if we get a potential recovery when that pivot happens, and then when you can jump in onto a leap call option. HIM, same thing. HIM still has, I think, some potential room down to at least $42 per share. If it breaks this golden zone, you're going down to $35 potentially, which we don't want to have. Chipotle is starting to show that kind of recovery that we're looking for here. Even a couple more day candles to kind of show that positive, swing around is going to be very good for the stock to get that nice rebound back to 47, back into the 50s maybe. UPS starting to show that swing. Hopefully want to get a little bit more as a result of that one. And then DraftKings swung already back up, but now it's retesting into that 61.8% retracement. So those are my 5 major stocks I'm looking at trading for potential leap options. Well, I would look at trading potential leap options with. Again, not financial advice, but these are stocks that would be on my radar for either buying shares potentially, or if you want to go options, feel free to do so as well. I don't see these companies going bankrupt anytime relatively soon. I think there's a lot of hype behind some of these, but if they can produce some good earnings numbers over the next couple of quarters, these could be in for some good returns long term. So that is it for the video. Thank you guys so much as always for watching. If you did make it this far in the video, feel free to like the video, subscribe to the channel, and turn on those bell notifications for all future Fridge Financials uploads. As we know, I'll probably be doing one on the big players in a later video where it's like NVIDIA, where it could be Tesla, where it could be Apple, Google, those kind of, heavy hitting companies. We'll do a leap option display potential. Look at the charts on that one next time. So again, bell notifications will keep you informed, and subscribe so that way you see the videos pop into your feed as per usual. I hope you're making money in the market, whether it's through options and leaps and buying shares or just through plain old index funds. And as always, I will see you guys in the next video.